Most people think there are three reasons they can't become financially free. They don't make enough money, they don't have enough time, or they don't have enough money to invest. And here's what's crazy. Those are almost the exact same three things that I used to believe as well. I thought making more money meant working more hours. I thought real estate required a ton of my time. And I definitely thought that if I wanted to buy a $500,000 property, I needed to somehow come up with $500,000. But the thing is, none of that turned out to be true. And once I understood that, it completely changed the way I look at money. Because today I don't look at an investment property and just think, can this Airbnb make me a few $1,000s per month? No, I look at it and think, can it produce cash flow? Can somebody else pay down the debt for me? Can the property increase in value? Can I increase the value myself? Can it potentially create legitimate tax deductions for me and my family? And most importantly, can this asset buy back some of my time, right? And create more free time for me. So that's what we're going to break down in this video. The three biggest hurdles to financial freedom and why I think strategically purchased vacation rentals are one of the most interesting tools available for overcoming all three of these. Now stay with me because when we get to number three, I'm going to show you why I don't have enough money to buy real estate doesn't necessarily mean what most people think it means. All right, guys, my name's Ashton. If you're new to the channel, my brother and I started investing in traditional real estate, duplexes, apartment complexes, multifamily, Section 8 properties back in 2018. Eventually, we had around 1,000 rental units under management. Then we bought our first vacation rental. That one property completely changed the way we thought about real estate because we began realizing that the right property just wasn't something that could appreciate over 20 to 30 years. It could potentially create meaningful income right now. And by meaningful, I mean $2,000 to $5,000, even $10,000 a month. And depending on your individual situation, real estate can also create some very interesting tax advantages. And that's what eventually led me to write the Vacation Rental Millionaire Method book. This video is based on chapter 3 of that book, actually. So if you want the entire framework instead of just what I can cover here, I'll put the link to the book below. But before you buy anything, understand this first. Hurdle number one, we've been taught the wrong income equation. Now, most of us grew up learning some version of this. Time plus effort equals money. You work an hour, you get paid for an hour. You want to make more, work more hours, or become more valuable per hour, right? Go back to school, get another certification, get promoted, become a manager, become an executive. I want to be clear, there's absolutely nothing wrong with having a job. In fact, your W-2 can be an incredible tool. It gives you income. It can help you qualify for financing. It can give you stability while you're acquiring assets, while you're building your portfolio. The problem isn't having a job. The problem is when your job is the only source of income, now you're at risk because there's a ceiling on how much you can earn. And there's a ceiling because there are only so many hours you can work in a day, in a week, in a month, and in a year. I don't care whether you make $20 an hour or $200 an hour. There are still only 24 hours in a day. So at some point you have to change the equation. Instead of asking, how do I make more money with my time? Start asking, how do I acquire things that make money without requiring another hour of life every time they get paid? This was one of the biggest mindset shifts for me. And I would say that the reason most people think things are so expensive right now is because they are paying for things with time of their life. Think about that, right? You dedicate time and effort, you get paid, and they pay for your life with time from your life. Food for thought. But think about a rental property. If you buy the right property and somebody rents it from you, that guest isn't paying you because you spent 8 hours working that day. They're paying for the use of the asset. Now, obviously, the property has expenses, mortgage, taxes, insurance, utilities, repairs, management, cleaning, supplies, right? And everything else that comes with operating a business, because don't get it wrong, it is a business. So I'm not saying buy an Airbnb and money magically appears, not even close. You have to buy it right. You have to analyze the deal correctly and you have to operate it correctly. But that's the difference. You're no longer exclusively selling your time. You're building a business that gives your family revenue for generations to come. And then something really interesting happens. You can potentially create income from your job and income from the asset. Then you acquire another asset and another. Now you've been separating the amount of money you can earn from the amount of time you personally have available. And that's leverage. Additionally, the thing that nobody ever talks about is that you could get all of your taxes back from your W-2 job, your 1099 job, if you bought and managed your own Airbnb each year. And I'll talk about how to do that in another video. But for now, just understand the real goal isn't quitting your job. And this is where I think people sometimes misunderstand financial freedom. Everybody makes it sound like the goal is quit your job. Maybe, maybe not. What if you actually love what you do, right? Awesome. Keep doing it. Financial freedom isn't necessarily about quitting your job. It's about building enough income outside your job that your job eventually becomes a choice, right? And that's a very different feeling. Imagine knowing if my company downsizes, I'm okay. If I want to take a month off, I'm good, right? If my wife wants to stop working, we have options. If I want to spend more time coaching my kids' soccer team, right? I got the time to do that. I'm not completely dependent on somebody else approving my PTO anymore, right? And that's freedom. Your career can make you money, but your assets can help buy back your time. And if this way of thinking is new to you, this is exactly why I wrote the book, The Vacation Rental Millionaire Method. The Vacation Rental Millionaire Method isn't just about Airbnb tricks, right? It's about building income producing assets around the life you actually want to live. I'll put the details below. You can pick it up there. But let's get to hurdle number 2, because this is where almost everybody says, that sounds great, Ashton, but I don't have time to run an Airbnb. Good. Neither do I. So hurdle number 2 is I don't have enough time. Now, when most people imagine owning vacation rentals or a business, they picture themselves doing everything. Answering guests at midnights, cleaning toilets, changing sheets, fixing garbage disposals, right? Adjusting prices every single morning, driving across town because somebody can't figure out the damn Wi-Fi. And if that's how you operate it, you just bought yourself another job. And you don't want another job. You want another asset. There's a massive difference here. And we'll get deeper into the automation and management in another video because that's an entire subject of itself. But before we talk about removing yourself from the operation, you have to understand why real estate is so powerful in the first place. Now, there are 6 different ways I want you to think about a property. And this is another part of the video I'd save because most people only think about number 3. The 6 ways real estate can build wealth. Now, number 1, it's easy to understand. Real estate is relatively easy to understand. It's a tangible asset. You can see it, you can touch it, you can improve it. And people need places to live, work, store things, and vacation. You don't need to understand some complicated new piece of technology to understand this basic concept, right? You own a property, someone pays for the use of the property. This business has been around for thousands of years. Obviously, understanding how to buy the right property is where the skill comes in, because a good property at the wrong price can still be a terrible investment, right? Number 2, appreciation. Real estate can increase in value over time, but here's what I like even more. In many situations, you have some ability to influence the value yourself. Maybe you buy an ugly house in the great neighborhood. You renovate it, add another bedroom, improve the outdoor area, you add amenities, you improve the layout. You're no longer sitting there hoping someone else makes a good decision with your investment, like in the stock market. Now you can actually improve the asset, increase the value of the asset. Imagine buying a stock and doing that, right? Now, obviously, appreciation is never guaranteed. Markets go up, markets go down. Individual markets behave very differently, but that's why we never buy investment properties based on appreciation. That's kind of the cherry on the top. And in the United States, real estate doubles in value every 10 years. So think about that. If you buy a $500,000 home today, it's going to be worth $1 million in 10 years. In 20 years, it'll be worth $2 million. In 30 years, when the mortgage is paid off, it'll be worth $4 million, right? And if you own it inside an LLC, inside a holding company, and inside your family trust, you've just created a tax-free generational stream of income because you can pass that on tax-free to your kids when you die. Really cool, right? But you have to make sure it cash flows first. And by that, I mean it has to pay for itself first. Otherwise, you've just bought a liability and not an asset. So number 3 is the cash flow. And this is the obvious one, right? Revenue comes in, expenses go out. What's left is cash flow. For a traditional rental, that's normally a tenant paying rent. With a vacation rental, you're essentially renting the same asset in smaller increments, right? A night, 3 nights, a week, whatever your strategy is. That's one of the reasons vacation rentals caught my attention. Our original financial freedom plan involved buying a bunch of traditional rental properties, Section 8 properties. That's where we started, actually. Now, those Section 8 properties, they made us about $300 to $500 per month, which if we had to replace a water heater, it would wipe out 2 to 3, maybe 6 months of revenue. But then when we bought our first vacation rental near Disney World, it produced roughly $70,000 in profit in its first year. Now that got my attention because now I started asking completely different questions, right? So instead of how many doors do I need to own to be financially free, I started asking how much cash flow can each asset produce? That's a much better question. 10 properties making you nothing aren't necessarily better than 2 properties producing a meaningful profit. Don't chase doors, chase good deals. And then number 4, and I mentioned this before, the tax advantages. So this is where things get really interesting. Taxes. And a quick disclaimer, I'm not your CPA. This isn't personal tax advice. Your specific situation matters. So talk with a qualified tax professional who understands real estate and short-term rentals. Reach out. I'm happy to recommend a couple. But one of the reasons the tax code has always fascinated me is that it doesn't treat every type of income or every type of asset the same way, right? So real estate owners can potentially deduct legitimate business expenses. Interest may be deductible depending on the situation. The property can be depreciated and you can get get 100% bonus depreciation from that property. Certain components of a property may qualify for accelerated depreciation. And under current federal rules, 100% bonus depreciation has been restored for certain qualifying property acquired and placed in service after January 19th, 2025. Now, notice what I said there, certain qualifying properties, not buy a $500,000 Airbnb and deduct $500,000. This is not how it works. The land isn't depreciable. The building itself follows its own depreciation rules. Cost segregation may identify shorter life components that qualify for accelerated treatment, and whether losses can offset other income depends on your specific tax situation and participation. But this is why I tell high income earners, stop looking only at what an investment makes. You should also understand what it may allow you to keep, because making $300,000 a year and keeping only $200,000 is very different from making $300,000 a year and keeping $250,000 to $300,000 a year, right? Taxes matter. So in short, understand that under the new tax law, you can buy an Airbnb this year and write off a third of the purchase price as a paper loss against your active income if you or your spouse manage that property. And we'll get into that in a whole nother video. You can check it out. I talk about taxes and Donald Trump's new tax law in a whole nother video. But that is how you get 5 to 6, even 7-figure tax write-offs in a single year. But look, if you're still thinking, okay, cash flow, depreciation, cost segregation, material participation, how does this actually fit together? Well, that's exactly what we break down in our free vacation rental millionaire workshop. I'll put the registration link below. We walk through the find, fund, and automate strategy and show you how we analyze these deals, as well as how to maximize the tax benefits and create a family business. There's no reason you should try to piece this entire strategy together from 47 random YouTube videos, right? Come to the workshop and we'll show you the framework. Link is in the comments below. All right, so number 5, net worth. This is the one people tend to forget because you can't always see it hitting your checking account every single month. So let's use a simple hypothetical equation. So say you purchase a property for $500,000. You put $100,000 down. Now ignore closing costs for a second just to keep the math simple. You start with roughly $100,000 of equity. Now imagine you improve the property and eventually it's legitimately worth $550,000. That's another $50,000 in equity, right? Meanwhile, every month, part of your mortgage payment may be reducing the principal. So whoever is staying at that property is helping generate revenue. And some of that revenue ultimately helps pay down an asset you own. Now, over the years, that can become significant, right? And this is why wealthy people tend to think in terms of net worth and not just salary. Salary tells me what somebody paid you this year, right? Net worth tells me what you've accumulated, and those aren't the same thing. Additionally, as this property, as this asset appreciates in value, you can always refinance or take a home equity line of credit against the equity that you have in that property, and you've just got a tax-free lump sum of money because you don't pay taxes on loans, and the interest rate on that loan can be a tax deduction for your business. So there's multiple levels to wealth building here. But number 6 is diversification. And I'm not anti-stock market. We own stocks. I'm not telling you to empty your 401k. I'm saying I don't personally want my entire financial future tied to one thing, right? One job, one retirement account, one company, one asset class. Do you remember Enron? Yeah, that happens. If you don't remember it, probably too young, but you can go look it up. They essentially liquidated everybody's 401k so they could pay the owners as they dissolved the company. But that's why I like owning tangible assets that can generate revenue independently of my salary. And that's the point. So write these 6 down. The real estate wealth stack. Number 1, it's a real asset, right? You can touch it, feel it, taste it, whatever. I wouldn't taste it, but you could. And then number 2, there's potential appreciation. They double in value every 10 years. Number 3 is cash flow, right? Everything that you make after expenses is cash flow, and it puts money in your pocket every single month if you did this right. Then number 4, tax advantages. You can get 5 to 6 figure tax write-offs from a single Airbnb. And number 5 is equity and net worth growth. It's growing your net worth, allowing you to access more capital in the future. And then number 6 is diversification. You're diversifying your investments over multiple opportunities, right? To minimize risk. And depending on the investment, you may benefit from several of those at the same time. And that's what makes this interesting. But wait, who has time for all this? Now let's get back to the objection. That's awesome, Ashton, but I work 50 hours a week. Well, so did I. I was actually in the military. My brother had a W-2. We weren't sitting around doing nothing, but you don't solve the time problem by becoming Superman, right? You solve it by building systems. Your goal shouldn't be, how do I personally perform every single task? It should be, how does every necessary task get performed without needing me? And that's how a business owner needs to think. So if you're evaluating a vacation rental, you need to be identifying your 4 buckets, right? The acquisition, how are you going to find and finance this deal? The setup, who handles the furnishing, photography, listing creation, and launch? The revenue, who's managing pricing and occupancy? And then of course the operation, who's handling cleaners, maintenance, guests, and emergencies. Now, if your answer to every question is Me, you haven't built an investment, you built yourself another job. Smart business owners are designing their exit from the operations before they even buy the asset. And I know what you're thinking. A lot of people are like, hey, I'll save money, I'll do it all on my own. But what ends up happening is you hire yourself for a job you hate and you never pay yourself. And so you have to think like the CEO. You think Elon Musk is down there building the motherboards to his rockets or building every Tesla car? Absolutely not. He's hiring the brightest and best. And so when we work with people to build their investment portfolio, one of the first things we do after picking the market is building the team in that market that's going to make your finding, funding, and managing your Airbnb business so much easier. But let's get into hurdle number 3. Now, hurdle number 3, I don't have enough money. Now we get to what I think is probably the biggest one, right? And you're probably thinking, this all sounds great, but I don't have $500,000. Well, neither did we, right? And here's the mistake. People see a $500,000 property and then assume they need $500,000. You generally don't. That's what leverage is, right? Banks lend against real estate every single day. There are conventional loans, there are investment property loans, there's DSCR products, home equity lines of credit, business credit, private capital, partnerships, seller financing, owner financing, rent to own. There's 101 ways to buy real estate. And no, that does not mean go borrow every dollar somebody's willing to give you. That's stupid. Debt isn't automatically good. Debt isn't automatically bad either. It's just a tool. Debt is a tool. A chainsaw is a tool. Used correctly, it's incredibly useful. Used like an idiot, you're going to have a really bad afternoon, right? Same thing with leverage. So here's the rule I want you to remember. Don't borrow money just because you can. Use leverage when the asset's expected economics justify the cost and risk of the capital. What does that mean? Only use leverage when the asset's going to pay for itself, right? When it's going to make more than it costs to own. That's it. If your financing costs you 9% and your deal barely generates enough money to cover the debt, you don't have some sophisticated millionaire strategy. No, you have a bad deal. You need a margin, right? You need reserves. You need downside protection. You need to know what happens if revenue is 20% lower than I projected, right? What happens if the HVAC dies and I got to replace it? What happens if regulations change, right? What happens if I have 3 slow months? Can this thing still be profitable for us? And that's investing, guys. All right, let's talk about other people's money and without all the Instagram BS, right? People hear investors talk about OPM, other people's money, and sometimes they interpret that as awesome. I'll take somebody else's money and then I have no risk. No, you absolutely have risk. You're responsible for that capital. The point of leverage isn't to eliminate responsibility. The point is to control a larger productive asset with less of your own capital when the economics make sense. So here's a simple example. Let's say you have $100,000. Option 1, you put that entire $100,000 into something that produces income. Fine. Your $100,000 is now tied up. Option 2, you use part of that capital as equity needed to acquire a productive asset. Financing covers the other portion, right? Guests produce revenue. The revenue helps cover expenses and debt service. And if enough remains afterwards, the asset produces cash flow. That's leverage. But the order matters, right? First, find a good asset. Second, understand the economics, like how much is it going to make versus how much does it cost to own. Number 3, figure out the safest and most efficient way to capitalize on that, not the other way around. Don't go get $100,000 in credit and then start desperately searching for something to buy. Deal first, capital second. All right. So if you watch this far and you're thinking, okay, Ashton, what do I actually need to do? Well, here you go. Screenshot this. Calculate your freedom number. How much does your household actually need every single month? Not fantasy money, right? What number would actually allow your job to become optional? Is it $5,000 a month, $8,000, $12,000? Write it down because financial freedom isn't a plan, a number is. And then step number 2, figure out your investable position, right? How much cash do you have currently? What's your credit? What's your income? What financing might you qualify for? What equity do you already have that you can leverage, right? Do you have retirement assets, potential partners? Don't assume you can't afford something before you actually understand your financial position. Step 3, pick a market. Don't search the entire United States here, right? Pick 2 or 3 markets and learn from them. And you want to research the demand, the seasonality, the regulation. But here's the big one. The average daily rate multiplied by how often it'll be occupied per year gives you your gross potential income for the year, right? And then the purchase price. What is the average purchase price in this market? If the gross potential income for the year divided by the purchase price is greater than 20%, you've got a great market there. But then step number 4, analyze 20 deals, not 2, not 3, 20. This is where you actually start learning, right? Run realistic revenue. Figure out what the mortgage is going to be, what the taxes are, the insurance, the management, utilities, maintenance, CapEx, cleaning structure, everything. You'll begin to see patterns here, right? Especially if you put this in a spreadsheet. And then step number five, build the operating system before you actually purchase the property, right? Find the cleaner, the handyman, the guest communication platform, the pricing, the bookkeeping, the emergency procedures, right? What technology are you going to use? Who's doing what? Build the machine and then put the asset into it. So let's go back to the three hurdles we started with. I need to make more money. Maybe, or maybe you just need more income producing assets that actually lower your taxes each year. Number two, I don't have enough time. Maybe, or maybe you're thinking like an employee instead of designing systems like an owner. And then number three, I don't have enough money to get started. Maybe, but first understand leverage, financing, and partnerships before deciding what's possible. None of this means buying vacation rentals is easy. It's not. And it definitely doesn't mean every Airbnb is a good investment. Trust me, they're not. There are people out there actually absolutely losing their shirt because they paid too much, their interest rate's too high, and they don't know how to manage it. I'm not trying to scare you, but you do want to make sure you buy right. But once you understand how income, assets, leverage, and taxes work together, you start looking at money very differently, right? And that's really what happened to me. I stopped asking, how hard can I work? And I started asking, what can I build and own that continues producing value, right? And that question changed my life. Now, look, if you want to go deeper, I've got two things for you. First, you can grab a copy of the Vacation Rental Millionaire Method. I'll put the link below. It walks you through this entire philosophy and the strategy we've used to build our own portfolio. And then number two, if you're serious about actually doing this, register for our next free vacation rental millionaire workshop. We'll show you how we approach finding, funding, and automating vacation rentals. The links are both below. And if you got something from this video, send it to the person who's been telling you for the last 5 years, because they probably need to hear hurdle number 3. And subscribe if you want more videos on vacation rentals, real estate, tax strategies, and building enough income producing assets to make your W-2 optional, right? And in the next video, we're going to attack what might be the biggest question of all. How do you own these assets without letting them own your time? I'll see you there.